Hi, this is Linda Hitt. We're going to take a look at a long-term debt for corporations, bonds payable, many types of bonds, but we're going to be looking at term bonds. So the characteristics of corporate term bonds, they may very well be set up with $1,000 increments, and they're all principal is paid completely at the end, not over the time, even though it can be up to like a 25, 30-year bond, or it could be 3 to 5 year bond. All the principal is paid at the very end, but we do pay interest as we go. So our stated interest rate printed up on the face of the bond along with the maturity date and $1,000 principal. Interest rates are often paid semi-annually or twice a year, or could be paid once a year. One of the differences in characteristics between a notes payable with the bank and a bonds payable is that the interest rates could be changing, and we may discover that we don't actually receive exactly what we had hoped to borrow. So if other bonds in the marketplace right now are being printed up with companies that have similar risk to us, a similar type of rating, if their interest rate is actually higher than our interest rate, then investors look at these other companies in the market and think they would rather buy their bond, so that there's less demand for our bond, and our proceeds, our cash that we receive, will be less. That's a way of adjusting the interest rate without crossing it out on the bond itself. If the opposite happens, and if for some reason the interest rates are changing such that they're dropping in the market, and we've just printed up our bonds, and again, other companies in the market with similar risk have lower interest rates, then the investors look at our bonds and like what they see and are willing to pay more than the face value, so that you may wind up actually issuing the bonds at a higher rate, which is a premium. And a little bit we'll look at an example. We'll deal with issuing bonds at a discount. So what are the advantages to using bonds for a corporation? And this is true also for other forms of debt. Bonds, the interest that you pay on the bonds are tax deductible, whereas if we raise money with common stock or preferred stock, the dividends that we pay to the investors usually don't have those same kind of tax advantages. So it's cheaper to borrow money. Investors have a little more flexibility. If they buy our bonds, they decide they don't want to hold the bonds until they mature, particularly if they're 25, 30-year bonds, they can actually sell the bonds in the market as long as somebody else wants to buy them. Now, what they can't count on is if they bought the bonds, they had a certain interest rate, but depending on what they get for them in the market, they may or may not earn that interest rate that they had hoped for, was printed on the bond itself. For the corporation, we may have a break. If we go to the bank, we borrow everything from one bank. That institution bears a lot of risk, and that institution may charge us more money. But if we issue bonds and that risk is spread out over many companies, foundations, or individuals, we may be lucky to get a lower interest rate in the process. The other thing that's nice for the corporation, if they decide they don't need all the money for the entire length of time, they can go into the marketplace themselves and buy back their own bonds and retire them, or they can buy back all their bonds. If they have a call feature, the corporation can actually force the investors to give back the bonds. It's all spelled out. They have to pay them a certain amount to do this, but that's also a nice feature to have. Disadvantages: there may be some major restrictions on the company if they issue bonds that come with this. For example, they may not be able to pay dividends to their owners over the time they hold those bonds. They may not be able to buy back their stock and have treasury stock, or they may have limitations as to not being able to borrow any more money. So that's a drawback. And of course, as anyone borrows more and more money, the interest rates will probably be higher, so there's a point reached where there's probably not an advantage to borrowing anymore because you can't earn enough money to offset the costs. And as an unsecured debt, it's not tied in with a house or car or something else, our rate expense that we pay will be based on our credit score as a company. So if we don't have a good credit score, we don't have a good financial standing, then we will pay more interest. So let's go ahead and try our example where we're going to issue $100,000 of bonds, and because the interest rates are actually going up, our bonds don't look as good. So the cash that we're receiving for these bonds, it says 97. So for a bond, if you're quoted at 97, that means 97% of face value. If it was a stock that was quoted at 97, that'd be $97 per share. So we have 100,000 bonds. So yeah, 1,000 apiece, 100 bonds. And if we multiply that times 0.97, then we're actually getting 97,000. Okay. The bond itself, and I'm going to skip a space here, the bond itself has got to be recorded at face value, at what we have to pay at the end at maturity. So we have $100,000 bonds, so at maturity we're going to have to pay $100,000. Now, I don't know about you, but we're not going to start unbalanced journal entries. So obviously we need something else. To balance this entry, you can tell we need $3,000 on the debit side. So that's our shortfall. If it weren't for matching, we would just call it interest expense and get it over with, because that's really what it is. It's an extra cost of borrowing, probably because of the interest rates changing. But because of matching, and if it's an immaterial amount, we could do this, but because of matching, we can't do that. It's a 5-year bond, so we have to spread that shortfall over 5 years. So unfortunately, we have a new account called Discount on Bonds Payable, and it's actually a contra liability. So eventually, it's going to be a holding place for the shortfall, and then eventually we're going to move it over to interest expense gradually over that 5-year period. So the impact on our statements, we have more assets. It's a compound, I'll put in the amount. Our assets are higher, and because we have bonds payable, 100,000, discount 3,000. You subtract 3,000 from 100. You can do that. 100,000 bonds payable minus 3,000, of course, is the 97. So the debt also goes up by 97. No effect yet on your stockholders' equity or income until you start having interest expense accrued or paid. And the cash flow, of course, yes, we do have cash flow. And this is a way of raising money or financing the business. So we're going to have financing, cash inflow for 97. Okay, so we've got the money. Hopefully we're going to do something really good with it and make a lot of profit. December 1st is 6 months later. We make our first 6-month interest payment. So if you remember interest calculations from anything else, it's the principal times the interest rate, which is always given. Whoops. And then the time in this one, we borrowed it June 1st. We're making the first payment December 1st. That's 6 months later. So the interest rate is a 12-month rate. So we use 6 over 12. And let's see what that comes out to be. Hopefully I'll do it right. $6,000. It's a lot of money. So that's the check we write every 6 months. Since the cost of this liability and the payment for that cost all occurs in the same accounting period, then we don't have to do an accrual of this. We can just say interest expense and cash. We pay as we go with the bond of this type. So what does this do? We have less resources, right? Cash is an asset. We have less cash. Interest expense is stockholders' equity, so retained earnings will be less, so will stockholders' equity. Your profit will be less because of expense. And then the cash outflow will be operating because it's an expense. And of course, it's a negative. So we have a lot of decreases when you make the payment. Okay, we can start tracking. I'm not going to track cash, but everything related to the bond, we'll see that the bond, of course, has all debt or liabilities have credit balances. Contra liabilities do have debit balances. So that will be our discount. And then if we track the interest, we have that first amount, which was $6,000. Okay, then we reach a point where every time we pay interest or accrue interest, we're also going to deal with moving the discount from its holding place over to interest expense. So initially when we borrow the money, the debt is really worth $97,000 because we received $97,000. But when it matures 5 years from now, it's going to be worth $100,000 because we're going to have to pay $100,000. So the amortization of discount, we're going to have an interest expense, an extra cost, which makes sense. We were short. This wasn't something we wanted, just the way it worked out. So we reduce the discount, we increase the interest expense. And we're using a concept like straight line depreciation. So maybe I should write it over here too. So this is the amortization of discount. We are going to take the discount amount, which is $3,000, divided by 5 years. And we've only had 6 months. So for this period of time, we're going to take 6/12. So straight line depreciation, whoa, get to the calculator. 3,000 short divided by 5 years would be $600 a year. And then if we take half or 6/12, we got $300. So we take an appropriate amount and move it to the interest. So it's not just the $6,000 we're paying, it's also part of that shortfall shows us as an extra cost of having this borrowing. If we needed $100,000, we're going to have to borrow $3,000 from somebody else. So what really does the amortization of discount do? Well, good question. If you reduce the negative account or contra account, you're actually raising the debt. Two negatives make a positive. So decreasing the contra liability causes liabilities to go up. And an interest expense is retained earnings. If you look at that, stockholders' equity has to come down. So here's an interesting impact. The assets aren't affected on the balance sheet, but we see just on the right side, one up and one down. So we sometimes will refer to this as a claims exchange. Remember the asset exchange? Well, now this is the claims on the right side of the equation. And of course your profits are less because you have an expense, and of course there's no cash. This is again done periodically. The cash was affected when we first borrowed the money. Okay, so what does this do if I bring it across? We did the interest. So you can see we're tacking on an extra $300 because of a pro rata share, fair share of that discount shortfall. And then the discount's going down, and eventually the discount will become zero. Okay, then we're at the end of the year, we're going to do an income statement, balance sheet. We got to bring everything up to date. We've had that debt for 7 months. We've entered everything for 6. So we're going to accrue the interest. And I imagine you might remember an accrued expense. So it's our best attempt to pick up all liabilities, whether we paid them or not. So interest expense, interest payable, and guess what we're back to over here? It's the principal times the interest rate. And since the interest payment was December 1st, we updated everything for interest as well as amortization. So now we need to just accrue, apparently, just 1 month, the month of December. So our calculation over here is 1/12. So if we do our math, we have a principal times the interest rate, and I'll just divide it by 12, I guess. So $1,000. We'll put that in. An accrued expense should have the impact of raising your liabilities because of the interest payable. Interest expense is a retained earnings account, causes stockholders' equity to go down. We have less profit because we have an expense, and because it's an adjustment, most adjustments do not affect cash except the bank rec. Okay, so that has the impact of throwing an extra $1,000 in the interest. I'm not sure why that went red, but we'll just ignore that. And then interest payable goes up by 1,000. Okay. And then we have to update the discount or premium amortization once again. So just as you can imagine over here, we don't really have to do this each time because we know it's straight line, but it's basically 1 month over 12 is our calculation. So we have a lot of calculations here. If you remember, it was 600 per year. Divide by 12, it's 50. Try to pick something that could come out evenly. We wouldn't have to deal with cents, but if you do have cents, just round up to the nearest dollar. So same titles we had before. The expense is increased and discount on bonds payable is decreased. So if you look up to this part, I'll repeat it, but it's the same thing. Your liabilities go up, stockholders' equity goes down, net income goes down. And once again, we see interest expense increasing. 50 and the discount, whoops, goes down 50. Okay, so end of the year comes. We can look at the impact on our statements. So what's going on with the discount? Well, we started with 3,000, and then we credited or reduced it by 300 for the amortization for 6 months and 50 for amortization for 1 month. So we had 7 months amortized, 2650. So instead of putting the balance here, I'm going to put it right up there. 2650 minus 2650. And then the bond payable remains at its original amount. So that's, I guess, part of the reason with the discount is we're showing that shortfall separately. And the bonds payable is the maturity value. So what is the book value or net value for the bond? Is simply the difference. What we pay at maturity less what's right now. Whoops, I did that wrong. Try that again. Maturity amount less what's remaining in the discount. 97,350, hopefully. Okay, so as we reduce the discount, we actually increase the bonds payable, liabilities go up. And we saw that impact when we amortize the discount, liabilities actually increase. So let's see what happens in year 2. And you'll find out the good news is once you get through a complete bond year, you sort of have all the entries pretty much down pat. So June 1st, we paid the second 6-month interest payment. Now there is one more complicating thing with the second payment than there was with the first. The first payment was expensed and paid in the same accounting period. This payment has already been expensed a little bit, 1 month over here from last period. So one suggestion would be to, like we've sort of split up notes payable and notes receivable, is go ahead and update the interest for this. So we have 5 months. So if we just do the calculation, we're looking at 100,000 times 12% times 5 months, January, February, March, April, May. 5 divided by 12. Of course, that should be 5,000. So we're going to do it as a 2-step. We're going to accrue the interest, kind of bring that up to date, then we're going to make the payment. So it's interest expense, interest payable. I didn't leave quite enough room, but that's okay. Okay, so we have the accrual of interest, which again, we looked at the impact before. And if I bring it over here, we have 5,000 for the interest, and interest payable is 5,000. Whoops, not that much. So what is it that we're going to have to pay? Well, 1,000 from last month, which is in a different accounting period, 5,000 for this 5 months. Together, there's the 6 months. So you're going to pay, and I'll squeeze it in here, you're going to pay interest of the total of 6,000. So we can make that interest payable count 0. And then we're going to credit cash. I think really probably break it into 2 steps like that is not a bad idea. So the accrual of interest, we've really already done that. We've looked at liabilities going up, stockholders' equity coming down, net income coming down. And then the second entry, simply paying the interest, is interest payable, liabilities going down, and your assets going down. And your the second part, no effect on income, and then your cash outflow, and that would be labeled operating. Okay, so when you're finished with that entry, your interest payable now is 0, hopefully, last time I checked, and we've paid cash. So this is paid off. And the good thing, we've gone through 2 payments, last year and this year, so the pattern's set. Now, on June 1st, well, let's go ahead and do the June 1st entry, which is still different. We have January, February, March, April, May, so that's 5 months of discount since the last time to amortize. So if I do my calculation, and again, I should put this in here, it was $600 per year. We have 5 months, so times 5 divided by 12. So we can only do 5 months because all we've held it. And so I have 250, 250, and 250. And I guess that makes sense because when we did it for 6 months, it was 300. Okay, so titles are the same as we've done before: interest expense and discount. Okay, so no surprise on that one. We've done the impact on the statements before. And then I can update this to 250, and the discount will be credited for 250. And the one thing we didn't do, let's go ahead and do it now, is this is what happened with the bond. So instead of $97,000, it was a little bit more because we had amortized some of the discount. So what is the impact on the income statement at the end of the first year? We had $6,000 paid, $300 amortized discount, which impacted interest, and then we accrued $1,000. So we had what? Let's see if we can calculate. First 3 numbers in interest: 6,000 plus 300 plus 1,000, 7,300. So if I come down here, I can put 7,300, but it wasn't a full year. The revenue we don't have to worry about, so we're just tracking the interest. Okay, so then in year 2, we made the first payment, we took care of that. December 1st payment should be identical to what we did December 1st last year. So I'm going to, it's going to change the color, but that's okay. I'm just going to cut that right off of last year and plug that into this year. With the approach we're using, it's going to be exactly the same. If I can get it to stop there. There we go. So again, we make the payment. Again, we amortize a fair amount of discount. You know what I did? Let me do this again. I got the wrong one, didn't I? I want the December 1st. In fact, I can do the whole thing. Let's do that. To finish the second year, I just decided to go ahead and do that. Once you go through a full 12 months or bond year, it repeats. The pattern's set. So December 1st of next year, I'm going to do the exact same interest payment, same amortization, and then December 31st, the same 2 adjusting entries. So I'm going to come over here and just plug those guys right in there. Hopefully this time. There we go. Okay, so we won't look at the impact for those. So that's a good thing. And so what happens to your balance sheet the second year? If we just subtract the discount. I think we can do that without posting everything. That took us, we did all that for the first year. If we go into the second year, the discount account, let's see if we can find it. It's $250 here, and that may be from the first year. Yeah, that's actually, I mean, that was, we did post that already. And then we have $300, let's post that, which is here. And then the end of the year, we did the 50. Does that look okay? December 1st was 6 months, yeah. June 1st, 250. Okay. I guess that makes sense. Because we have the first payment, we amortized, and accrued. Oh. Yeah, 350, 250, and then 350. Okay, so for year 2, of course that should make sense. We should have a year and a half. No, we had 7 months. So if I take, let's see, 3,000 divided by 5 years, it's 600 per year. So we had the second year, a full year of amortization, which would be 600. So we can pick that up. Let's just write that in. 600 for year 2, plus how much for year 1? Well, we had 600 per year, and we had 7 months, right? Times 7 divided by 12. So it's 350. All right, that makes sense, I think. Okay. So, yeah, plus 350 year 1. So we have together then, we amortize 600 plus 350. 950, so I can subtract that from the original 3,000, and it looks like we have 2,050 unless I made a math error, which is always possible. 2,050. Okay, assuming the math is okay. So I just want to point out to you what's happening with your book value of your debt. You always have the maturity amount, principal, less what's left to amortize, your unamortized, 97,950, 97,950. And you can see your book value is going up until finally in the last year. I promise you, I will not do 5 years. That would be too much. But in the very last year, of course, you'll pay it back. But actually, I can't do it. It's 6 months here. So actually, it's going to be, yeah. Well, I'll just put this up here. This would probably really be in year 6 before you make the payment. Eventually, because you got a half a year or partial year the first year, 4 full years, and a partial year the last year. So anyway, what I was just trying to say is eventually, before you pay those bonds, you'll have no discount, and what is principal is actually what the book value is, and that's what you have to pay. So the point is, we're trying to say is the discount amount remaining on the balance sheet slowly goes down. You subtract less and less and less until there's nothing left to subtract, because all the discounts been moved over into interest expense, and that tracks. And interest expense, once you hit year 2 and you have a full year, it's going to be the same throughout. And so we can sort of prove what that's going to be. We would have, what? Your original amount, let's try it a different way. 100,000 times 12%, that's a full year of interest. So we had a full year. For year 2, it would be a full year of 12,000, and then what we amortize. If you remember, I think we've done it enough times, hopefully, that's 6, whoa, what did I do there? We have 12,000 plus 600. the full year worth of amortization would be $600. So that's $12,006. So interest expense every year after year one, since you have the same pattern, as we mentioned, once you hit that first bond year, all the way through would be that. So because of the straight line amortization. Okay, so I think the very, very last thing, I promise you, that's it. This will end. It's long enough, this clip. You've paid all the interest, you've amortized the discount, the discount account is gone. The only thing that's left is your bonds payable. And at that point in time, whatever year that is, you simply pay back the principal. So bonds payable goes down, and so that's finally wiped off the list. So bond 0, discount 0, interest payable 0, interest expense will be closed into retained earnings, and that's all she wrote. That would be the last thing, and there's no big surprise here. You have fewer assets when you pay off your debt. You have fewer liabilities, which I guess can be good. And you've dealt with the interest and all that stuff before, and the cash outflow would be financing. So borrowing and repaying are both financing. So hopefully you have a little bit of an idea of how the bonds work.